Welcome. Thank you for taking time to give this entry a look. The purpose of this video is to provide an understanding of what to expect from NeoAnalysis going forward, and to explain wave counting, along with the core ideas behind the methodology. NeoAnalysis is the study of market price action with the goal of discovering and resolving wave structures in crypto assets. The methodology is rooted in neo-wave principles and treats wave counting as a process of observation and measurement, rather than pattern assumption. This work is offered as analysis and exploration, not as financial advice. For this entry, total was selected. This entry is part 1 of 2. Total represents the aggregate market capitalization of all cryptocurrencies. It combines Bitcoin, Ethereum, and the broader altcoin market into a single benchmark. Because it reflects overall market liquidity, risk sentiment, and cycle dynamics across the entire crypto ecosystem, Total often provides a clearer view of macro structure than individual assets. The platform used for charts in NeoAnalysis is TradingView. All wave counts are conducted on candlestick charts denominated in USD. Markets can be understood as a visual expression of human behavior and psychology. NeoWave provides a structured framework for interpreting the repeatable patterns that emerge from this behavior. These patterns are analyzed through measurable relationships in time, price, and proportionality. NeoAnalysis uses common duration, retracement, and extension levels, as well as Fibonacci ratios, to assess wave relationships and the nesting of degrees. Wave counting is performed on a logarithmic scale, rather than a linear, arithmetic scale. Logarithmic scaling better reflects percentage-based price movements and proportional relationships between waves. Linear scaling can distort wave proportions over extended time periods and is generally avoided for wave analysis. Wave counts are constructed from the largest identifiable structure. The chart and starting point are selected to support this process, beginning with the chart that provides the most available history. This allows time relationships between waves of comparable size and function to be evaluated over the longest possible period, providing a clear macro understanding of the overarching structure. Time relationships are given primary weight during validation. Price relationships serve as supporting information, but are generally considered secondary when assessing structural consistency. Certain time ratios appear more frequently than others across market structures, and these tendencies are used as reference points when evaluating proposed counts. To compare how long one wave lasts relative to another, Fibonacci ratios, commonly called fibs, are used alongside other commonly observed ratios. Common time ratios are used to assess the duration of waves. The time-based fib tool is placed from the start to the end of a wave, then projected forward to measure proportional time relationships with subsequent waves. Common retracement ratios are used to assess wave relationships. When using the fib retracement tool, measure the full price range of the base wave, placing the low anchor at the end of that wave. Common extension ratios are used to project the potential length of the next wave. The fib extension tool is anchored at the start and end of the base wave, then extended from the end of the corrective wave to measure the projected move. Certain ratios appear repeatedly in how waves relate to each other in both price and time. NeoAnalysis uses these ratios as ranges rather than exact targets. Specific wave highs, lows, and terminations do not have to land precisely on a ratio. Instead, they provide logical zones where structure often completes or shifts. This approach treats wave counting as a process of measurement and observation rather than pattern assumption. Once the larger structure is established on the chart with the most history, analysis can later be refined using the specific exchange chart on which trading will occur. Price action on any market chart does not move in a straight line. It moves in waves, periods of rising and falling prices. Most markets are corrective in nature. This means the majority of waves are labeled as simple corrections, ABC, triangles ABCDE, or complex variants, W, X, Y, or W, X, Y, X, and Z, rather than impulsive 5-wave structures, 1, 2, 3, 4, 5. In simple corrections, price often moves in a basic ABC structure. The A wave is the first leg of the correction. The B wave is a deceptive relief move against the direction of A. And the C wave is the final leg that usually extends at least as far as A, and often beyond it. The main legs of a complex correction are labeled W, Y, and Z. The W wave is the first major corrective leg. A connector, or X wave, is the intervening wave that links two corrective structures, such as W and Y, or Y and Z, inside a larger complex correction. X waves serve as a relief mechanism that allows the market to pause, release pressure, and reset before continuing the broader corrective move. After this relief, the Y and Z waves continue the correction in the same direction as W. If the market requires additional structure, a second connector, X2, may appear, followed by the Z wave, the final obligation leg that completes the larger corrective structure. These legs, W, Y, Z, connected by one or more X waves, together form the complete complex corrective pattern. Waves exist in many different sizes. A large, multi-year move contains smaller moves inside it, and those smaller moves contain even smaller moves within them. This nesting of waves inside waves is a fundamental observation in wave analysis. To track the size of waves, degrees are used. Degrees function like different zoom levels on a map or different generations in a family tree. A larger degree wave serves as the parent structure to the smaller waves nested inside it. The key principle is proportion and nesting. A wave at 1 degree should generally be larger and longer lasting than the waves contained within it. Labeling waves with degrees organizes what is observed and prevents confusion between short-term fluctuations and major structural moves. Without degrees, charts can appear as a confusing series of ups and downs. Degrees provide a framework for identifying the relative importance of a move within the market's broader development. They also offer context for how long a move of a given size has historically lasted. Large degree waves can persist for years or even decades, while the smallest waves may last only minutes or even less. Thank you for taking the time to explore this video. Part 2 will expand on total and the methodology used. Please remember to subscribe and follow NeoAnalysis on X, YouTube, and Substack.